Good morning. This is the Zero DTE. I'm calling it the War Room, but it's really just the Zero DTE podcast. And I'm Coach Ernie. And it is, let's see, we got to check all of our stats. We see that, yes, we have mic and we have video, so we're good to go. Hey, it's Monday morning. I hope you're all doing well and had a wonderful holiday weekend. I did, and had good times with the friends and family. Anyways, now it's time to get back to work, and today is going to start a 3-part series on Zero DTE and the best way to trade it, taking into consideration volatility, market structure, and asymmetry. Last week, we talked about routine and why routine is by far the fast track to trading like a pro. Quite frankly, there is no substitute for building a proper routine. So I would recommend that you go back and take a look at Monday, Tuesday, and Wednesday. You'll see that the format's pretty much the same every week, where Monday, Tuesday, and Wednesday I have the show at 9:15 a.m. Eastern, and we wrap it up into a series, all 3 of those shows that all go together. So this week we're going to be talking about the fundamentals of Zero DTE. And while I'm doing it, I'm going to be demonstrating a lot of that stuff on our application, our key application. It's called Fly on the Wall. And if you want to join our service, it's a coaching and mentoring service and a fantastic app called Fly on the Wall that is really a substitute for a wide range of apps that you've been using, but it is designed specifically to be able to analyze and trade Zero DTE trades. So we'll be looking at that as well. Today, we're going to concentrate on the VIX and volatility and what part it plays in Zero DTE trading. Actually, what part it plays in all of options trading. Because you know that volatility is one of the 3 dimensions of options. There's volatility, there's price, and there's time. And volatility by far is the thing that we key everything off of. Now, I know that there are a lot of Zero DTE traders that run away from volatility. They think it's either good or bad. And that's really just demonstrating their total lack of understanding of how volatility affects their trades. And so that's what we're going to learn today, exactly why volatility makes all the difference in the world and where it is and how you adjust yourself, how you orientate yourself to it. Right? And so the easiest thing is to look at the VIX. All right. Why don't we get started? And what I'm going to do is switch over to the VIX. And thank you very much. And look, if you're watching right now, give this thing a thumbs up. And if you have any questions, make sure you put it into the comments section. I'd be happy to answer it. All right. And let's get going. And if you haven't subscribed already, go down below, subscribe. You got to take care of all this stuff. And I do have one other thing to say. We're in this for basically 3 goals, right? And that is to help you become consistently profitable, become an independent trader, right? And trade like a pro. Those 3 things: consistently profitable, independence, and trade like a pro. So that's what we're all about. That's what the Fly on the Wall service is all about. Go check it out. There's a Discord room available with it. You can get a trial. The link is down below. All right. Hello to everybody. Thank you very much for joining me today. Today we're kicking off our week on the fundamentals of Zero DTE trading. We're starting off with the most important thing, and that is the VIX. And now that I got all the niceties out of the way, let's get to it. All right. So first thing, this is something that I've been showing to you guys online for ages. And when I did my morning analysis show for about a year, every morning we would talk about where the VIX level is and how it would orientate us. And that's where we're going to start here. And I'm going to talk about the specifics of why we do it. Now, the playbook is really a culmination of thousands and thousands of trades and why we've got to here, but it's all based on solid math. And essentially, we're looking at volatility to determine the rate of decay of premium. Is there, and how much premium is there available to us? And the VIX is the arbiter for that. So keep that in mind. The VIX is telling us how much premium is likely to be available to us to extract from the market. And of course, we're doing 0DTE on the SPX, options on the SPX. It is the absolute best thing to trade. There are other options too. We can trade the NDX, we can trade futures like oil, gold, the Russell, NASDAQ, all kinds of things. But we focus, as well as energy. Someone had mentioned natural gas in my service yesterday, and I thought, yeah, that sounds pretty cool. I didn't realize, quite frankly, that it had 0DTE 5 days a week. But that's the other key. We like to do SPX because it's 5 days a week, and it's an index, so it's cash settled. We could also trade the ES, which is also an index, but it's a future. It's not cash settled, but it's still a viable product. It's just a different size. All right, now I'm getting sidetracked. Let's focus on why we're here. We're here about the VIX. And everything that, the first thing we do is we have to break down the VIX into regimes. And I look at it as having 3 major regimes. And I gave them names. There's Zombieland, Goldilocks, and Chaos. And Goldilocks is a pretty wide zone, so I gave it Goldilocks 1 and 2. So what does that mean? Zombieland is that area of the VIX that's 17 or below, super low volatility. And when there's super low volatility, there has been an accelerated rate of decay of premium. Probably didn't know that. And I'll tell you why that's not necessarily the best thing. I know people like low volatility because it's calm and easy for them. They think that they can get into a trade with relative ease. But from an options trader's point of view, because that premium has been decayed already, it leaves very little meat on the bone. So it's not so great. And I'm going to show you why it's probably the worst environment to trade in. And that doesn't mean that we don't trade in it. In fact, we are all over low volatility. It just means that you have to understand what you have to do in order to take advantage of the situation. Now, as we go higher, above 17 on the VIX and get into that 17 to 32 zone, we have the regime that we call Goldilocks. And it's a pretty big regime, so I break it down into 2 different levels, Goldilocks 1 and 2. I guess you can say Goldilocks 1 goes up to about 24.5, and then up to 2 goes up to 32. But Goldilocks, why do I call it Goldilocks? Oh, it's like the 3 bears. It's awesome. And we are there right now. Currently, the VIX is at 25.14, meaning that we're smack dab in the middle of the Goldilocks zone. And then the third regime that we talk about is chaos zone. Now, you might think that chaos, that sounds bad, right? But it's not. It's just a name. Chaos zone is 32 and above. Now, it doesn't happen very often. You can see, based on this chart, in the last 2 years, it only happened a handful of times that we get up into chaos zone. And quite frankly, if I had my druthers, I would much rather be in chaos than in Zombieland. Seriously. Because chaos spells opportunity, premium, right? Now, it might mean a lot, very different things to you because of the type of trading that you do, because you're never oriented to the VIX. You're oriented towards high probability strategies, which will give you extremely bad results in chaos zone. And quite frankly, everything about a high probability strategy is bad from an options trader's point of view, because you're putting in inordinate amount of risk for a tiny little profit. And that's a tough way to trade, man. And you'll see that as we go deeper into this series on Tuesday and Wednesday, and why that is, why the math tells me that is. And you're going to realize why it is. And you're going to wonder why you ever traded that way, and why you haven't been trading the way we trade, the asymmetric way, using out-of-the-money butterflies. Let's segue into out-of-the-money butterflies. Everything that we do is predicated on an out-of-the-money butterfly. That is our primary trade. We're looking to put on extreme risk to reward. That means very small risk, large potential reward, and an out-of-the-money butterfly is the easiest way to do. It gives us determinate risk and large potential reward and great optionality across a very wide spectrum of strikes. Now, I also want to say one thing, that because a lot of people think you put on a butterfly, you're intending to get inside the profit tent. That is not true. We are not intending to get in the profit tent. We would like to get in there, but it only happens about somewhere between 15 and 20% of the time. So we're not going to base all of our trades on getting into something that might only happen 1 out of 7, 1 out of 8 times. We know that the vast majority of our trades are going to be outside of that profit tent. And there's going to be an incredible opportunity there when you trade this way, the asymmetric way. So keep that in mind. All right, all of this, I'm just giving you all the caveats and the pluses and minuses and why we love volatility when it's higher and not so much when it's lower and how we adjust to it. This graph, this annotated chart, is showing us how we should orientate ourselves. And you'll see that there are 3 basic trades that we're looking at. The primary one is what we call the classic out-of-the-money fly, and it's showing us how wide we should be depending on where the VIX is. And then there are other edge case trades, one we call the Batman. That's where you put on a butterfly above and below, and it looks like Batman's ears. That's why we call it the Batman. And then time warp is the other edge case where we have super low volatility. But for the most part, we can trade a simple out-of-the-money butterfly any time of the year, any volatility regime. It doesn't matter. But what does matter is that we understand where VIX is and why we trade wider in high volatility and narrower in low volatility. I'm going to talk about that in great detail today. Again, if you have any questions, please put them up in the comments. And if you like this video, even if you don't, give it a thumbs up. All right. How did we come to trading 20 to 30 wide in Zombieland, or from 30 to 50 wide in Goldilocks, or even wider in Chaos? It's all about premium decay. And not just premium decay, but the rate of premium decay. Now, here's something you probably didn't know. And maybe you felt it and saw it, but didn't really quantify it. When volatility is super low, the rate of premium decay has accelerated. That means that there's much less. And I'm going to go over this in just a sec. Exactly why. And you're going to learn today exactly why you're going to love high volatility. All right, and it's all because of that decay rate. As you go into higher and higher VIX levels, the premium decay starts to delay. Now, what that actually means is that it's delaying, so it's not going away. You have more premium available to you on that very last day of expiration than you do in low volatility. This is really the number one reason why professional zero DTE traders get in the game, because there's so much more volatility and, as a consequence, more premium available to them to collect on zero DTE. Now, you may not have really thought about it that much, but there is a dramatic difference between high and low volatility, and we're going to look at that next. But I wanted to show you this, first of all, to introduce the regimes: Zombieland, Goldilocks, Chaos, and that we're looking at narrower flies in low volatility and wider flies in high volatility, and it's a spectrum. Okay? All right, let's move on to why. That's the big question. All right, and so we need to switch over to Keynote. There we go. And talk about the situation. All right, let's first of all take a look at the effect that volatility has on premium decay. And what you're looking at here is the life cycle of a weekly option. And in particular, we're talking about the SPX. So it basically comes alive about 8 days ago, and then it moves into here, and it starts off with a lot of premium. Each column here represents a day in the life of that premium or that option. And that premium decay is represented by the magenta line here that is slowly decaying. As you can see, it starts at 100%, and then right on as you get closer and closer to the zero DTE day, yeah, I'm going to get the presenter out a little bit and get some annotation going here. And we'll use red. So you can see 7 or 8 days out, we have a lot of premium available to us. So there might be a very good reason to take a trade that is 7 days out or 8 days out, sure. But the problem is you don't know where price is going to be after 8 days. So that's another issue. And we'll talk about that later on in future episodes, how we play future dates. But 0DTE is where we're at, and that's this day right here. And that's because as we're approaching this day, the rate of decay is increasing faster and faster. And you can see how on the 3DTE, it started to really pick up, 2DTE even more, and then 2 or 3 times as much on 1DTE. And then on that last day, that very last day, look how much premium is available. Almost about 50% on average of the premium that I had at the very beginning of its life cycle. 50%, all that premium in one single day. That, my friends, is what we're after. End of story. Right there. But is it always like that? No, it's not. That last day is the key to 0DTE trading, and then how you adjust to it and why we're there. Now, let's take a gander at what this is all about. We're talking about high and low volatility. So we're going to go to the extremes, and we'll say that down here we have those 2 extremes, low volatility at the bottom, high volatility at the top. And what characterizes low volatility from high volatility? The market is moving all over the place, right? But in high volatility, it's moving in a much larger range than it is in low volatility. Low volatility is a much smaller range. Everyone can agree upon that. So what does that mean to options traders? For options traders, for most of them, they're all gauging their pricing based on the probability that they're going to get in the money. And that's a very important concept. In high volatility, the probability of getting in the money starts increasing because of that range. You have intraday swings, you move very large amounts, and the probability of an option moving into the money appears, or from a trader's point of view, thinks that there's a higher degree of probability that they'll get in the money, because that's what they want. They want that intrinsic value. The reality is that all options, all long options, only about 12.5% of them get in the money. The rest of them expire worthless, out of the money. So getting in the money is a big deal, because that means that you have an unlimited upside to the value of your option if you get in the money. If you don't get in the money and hold on to the option until its expiration, then you're going to lose whatever the cost of that option is. So getting in the money is a big deal. And in high volatility, there's a wider range, so there's a greater degree of possibility of getting in the money. So we know that high volatility has big range, and so consequently, or opposite that, low volatility, we have small range, less ability to get in the money. So when you have high volatility and a high range, or expected move is another way to put it, then the rate of decay of premium starts, let's just say that premium in an option starts inflating. But what is actually happening? You have to look at that rate of decay line. Now, this is a normalized rate of decay. It looks like a perfect exponential decay rate. But what happens in high volatility is it starts inflating on each of those days. So each of those, that 3DTE, 2DTE has more premium available to it until you get to 0DTE like this, where you have a lot more. But then eventually it does decay, no matter what. Time is the final arbiter for decay. After you get to the afternoon of the 0DTE day, volatility has no more effect. It loses effect. Time is, as I said, the final arbiter. But on that very last day, because of that delay of premium decay, you have a lot more premium available on that day. That's in high volatility. On low volatility, it's exactly the opposite. Premium gets sucked out of that option. Sucked out. And so, in effect, the rate of premium decay is increased. So on that very last day, you have much less premium available to you. Now, that's a huge difference. High volatility, low volatility. So that is the key. But what does that actually mean? I think it's clear here that on that last day, I'd rather collect or have the opportunity to collect a lot more premium than a lot less premium. And that goes without saying. And for you high probability traders, you're not even looking at this. All you're doing is putting on super high risk trades to get a tiny little bit of premium. And because your premium amount is so small, you don't even see this difference. But imagine if you put on an exact opposite trade where you took very little risk and go after very large amounts of premium. You would start realizing that volatility is a godsend because it's just totally inflating your option strategy with huge amounts of premium, huge profitable outcomes. And you would no longer look at those high win rate strategies because they are passé. It's like picking up nickels in front of a steamroller. And you're going to get burnt. You're going to get rolled over eventually. It happens to everybody. But our way of trading, by trading small risk, large potential premium, and leaning into the volatility, we'll never get rolled over. Our risk is super small and defined. We don't have to use stops. We use options to define our risk. Can you imagine the audacity of using stops with your options trades? That's crazy. Why would you ever do that? There isn't a pro that I know that does that. They define their risk through the strategy. And that's what we do. And I'm showing you how to abandon that high win rate strategy because that's the retailer loser way of trading. What I'm showing you is the pro. Remember, I said consistently profitable, independent, and trade like a pro. Right? So I'm showing you the pro way of trading. That's a relatively low win rate, say around 50%, but you're going to have more consistent profits, and the return on the capital that you put to work is going to be nearly 50 times greater. Now, I'm going to repeat that. The return on the risk that you put up with this type of strategy versus the high win rate iron condor strategy is 50 times greater. Let me put that in more exact terms. For every dollar that I put on, I would expect to receive 50 times more dollars using this strategy than your high win rate strategy. 50 times. That's no joke. That means that for someone who's making, say, $10,000 a month off the high win rate strategy, they're probably putting up or risking as much as $90,000 or $100,000. That same $10,000 that I would make on my strategy, I'm putting up about $1,000, right? Maybe $2,000 tops. So it's really, I'm using 50 times as a low bar. All right, let's move on. I know, I get so excited about this. When I show you the difference and you see why, it starts making a huge difference in your life that, look, I'm in it to be an efficient trader, right? Why would I put out $1,000 to make $50 when I can put out $100 to make $1,000? Duh. Okay. So here's the first clue here, and that is this accelerated premium decay or decelerated premium decay. It decelerates in high volatility, giving us more premium. That's why options traders love it. And it accelerates in low premium. That's why we have to adjust our strategy in order to be able to manage that extra risk. And that's the other key. Low volatility is higher risk for all options traders. Even you guys that are doing high win rate strategies, it's higher risk to trade in low volatility. You run away from high volatility, you high win rate strategy guys, because you don't know how to trade. You're trading with the crowd. You think that iron condors are it. But then every once in a while, you get that huge loss and it wipes out weeks and weeks of profits. That never, ever happens with us. All right. Now I'm going to move on and I'm going to show you what that looks like using an asymmetric trade out of the money butterflies. But first we need to clear all this stuff and go to the next slide. And that's showing you a butterfly and how it behaves in this high volatility versus low volatility. Now, for those of you that are just listening to this podcast, you can't see it, but let's imagine that we're looking at a risk graph. And we're looking at two at-the-money butterflies. And one of them is showing you in high volatility and one in low volatility. And you know what a risk graph is. It is showing you the zero line. That's where your break-even is. You put on a butterfly and you have a certain debit to it and a certain amount of profit potential. So what I'm showing now is the difference between high volatility and low volatility. Same butterfly, same width, at the money. All of that stuff is the same. The only thing that's different is volatility. And I'm going to show you this in our tool too, so you'll see how this manifests itself. But here we have high volatility. You'll see that the butterfly is sitting really high relative to that break-even line. In low volatility, it's sitting very low relative to that break-even line. And that's demonstrating that premium decay, because in high volatility, you have all of this potential on that 0 DTE day from the zero line to the apex of that butterfly to collect, and a tiny little bit of risk. So you have small risk, large profit potential in high volatility. In low volatility, it's the exact opposite. You have very little premium available, very little potential. So you have small profit potential and huge amount of risk. So now you can see the direct effect of volatility on an options trader who's trying to collect premium. That's why they love high volatility, because it gives them way more profit potential and way less risk getting into the trade. Where in low volatility, it's the exact opposite. I have huge risk and small profit potential. Can you not see how accelerated decay sucks in low volatility and delayed decay in high volatility is a dream? But there's more. There's much more. And that's the gamma equation. I know a lot of you want to know about gamma. How does gamma fit into all of this? Low volatility typically means that you're going to have high gamma, and I'll show you why. And high volatility, lower gamma. So gamma, you can think of gamma like, positive gamma is like going up a hill, right? You're going up a hill and there's resistance. And so it takes some effort to get up that hill. You have to grind it out, right? That's high gamma. And they call that compression. In low gamma, you're going like on the other side of the hill, going down. And your gravity is pulling you down. And so you can go much faster, but it's also reckless. And so that's low gamma. That's expansion, right? So that's gamma. But gamma, more specifically, that's the effect that it feels like. But gamma specifically is the technical definition, is the sensitivity to price movement. So in low gamma, you have very low sensitivity to price movement. So for every 10 points that it moves, the value of your fly doesn't fluctuate very much. That's the situation that you have in high volatility. You have very low gamma, basically meaning that the real-time profit curve on your strategy has very little slope. It's flat. And you've probably noticed this, that in high volatility, even going deep into the day, not much has happened, right? That's because the rate of decay has been delayed, and so it's not happening. It's just there. It's just bloated inside of your options. And so in a butterfly, this is the result. You have a very flat profit curve, or a real-time profit curve, and the slope of that profit curve is really your gamma. So for every 10 points or whatever unit that you want to use, you don't have very much change in value. It's very shallow slope. So there's another advantage of high volatility. You have very little sensitivity to price, so it's easier to be in a trade. You have much more profit potential, and it costs less to get in. In low volatility, it's the exact opposite. You have very high gamma, an expansion zone, where you have that same 10-point movement will result in a big difference in the value of your option, of your position. And that means that the slope of the profit curve is much higher. And so that creates a much higher sensitivity to price. So low volatility has everything going against it. You have higher sensitivity to price movement. You have much greater risk and much less profit potential. I don't know. Where would you rather trade? I mean, this is like a no-brainer. I would much rather be in the place where I have low risk, high profit potential, and very low sensitivity to price action. That to me seems like a dream, and it is. Low volatility is the exact opposite. High sensitivity to price, extreme risk, and small profit potential. There you go. That is why we love high volatility. Or we like medium volatility too, but low volatility, it sucks. And it is also why we change the width of our flies, but that doesn't tell the whole story. In order to be consistently profitable, you need to do things consistently. And so we look at risk to reward as our consistency measure. We try to trade between 5 and 10% of the width of a fly. What that means is we try to take a risk that is only 5 to 10% of the width of the fly. So in other words, if we have a 30 wide fly, the max risk that we're going to take is $3. We might take as little as $1.50. But you can see by that results in a 1 to 9 to 1 to 18 risk to reward. Now you might be thinking, whoa, wait a minute, what is this wizardry, Ernie? What are you talking about, a 1 to 18 risk to reward? That's crazy. We're usually going for a 3 to 1 or 2 to 1. 1 to 1 is like a dream, right? We would never even consider a 1 to 1. Our lowest is 1 to 9. In other words, for every dollar that we put up, we're going after $9, where every dollar that you're putting up, usually on an iron condor, they're looking at $9 for every $1. So you see, I call this the inversion of risk. It's just flipping the script, right? The 10% debit rule is not something arbitrary. Here, I'm going to go to the big head and talk about this in a little bit of detail here so you understand exactly what I'm talking about and where this all comes from. So I've been in this industry for a long time. Been in professional life for over 40 years. But about 25 years ago, I was the chief architect for Sun Microsystems Professional Services. And I was in charge of all of our Tier 1 clients, which mainly resided on Wall Street or in the insurance industry in the Northeast. And I lived in the Northeast, so I basically commuted to New York City every week on Mondays and came back on Thursdays. I had an office in the World Trade Center, and I spent a lot of my time down on the NASDAQ or the American Exchange or any of the number of banks that are there, like Credit Suisse, TD, HSB. They were all my clients. And we were, at that time, Sun was the king of the hill for Wall Street. Virtually everybody's hardware and a good majority of their technology ran on Sun technology, Sun hardware. And so we had projects going on all the time. While I was there during the dot-com era, my team literally built Wall Street during the dot-com era. I mean, that's my legacy. Built Wall Street during the dot-com era. And so I got a chance to go down and watch projects or oversee projects, and I remember one time I went down to the American Exchange floor to meet a friend of mine. He's a trader. And he was showing me this thing that they called the 10% debit rule. And that's where they trade out of the money butterflies. And they don't take a risk more than 10%. And at the time, I thought, okay, that's interesting because I wasn't a full-time trader at that point. And I thought that was interesting, but it stuck with me. And I started to realize, the reason why they're doing that is that they're putting on trades that give them that asymmetry and also the optionality that they would have on that trade. Excuse me, need some water. Now, it came to me a few years later when weekly options started to come out, and I was trading Apple, and that was one of the very first weekly options. And I started looking at these out-of-the-money butterflies and the 10% debit rule, and I started realizing the brilliance in this move and what it was providing for them. It was allowing them to maintain a consistent risk to reward. So this where the consistency comes in and how they approach the market. However, if they kept the risk to reward relatively consistent between 5 and 10% of the width, something else had to give in order to keep that. And what gave is the width of the fly. And they found that in high volatility, you could go much wider because you could get a much bigger fly for that same amount of money that you would be paying. Versus low volatility, you'd have to go much narrower and play that low volatility game. And so that's where the change in width came from, by following what pro traders did on the floor, these actual floor traders, using the 10% debit rule. What I found was that there was a much greater spectrum of results. And one of my mentors, Perry Kaufman, once told me, big pants fit more butts, Ernie. Find a strategy where you can have a range within which you can work in and try to make it as wide as possible. And that range is actually that 5 to 10% of the debit, or between a 1 to 9 to 1 to 18, let's just say 1 to 10 to 1 to 20 risk to reward for 0 DTE trades seems to be the sweet spot. And it gives you enough range that there's a lot of money to be made, but keeping your risk-adjusted returns consistent. That's the key. Risk-adjusted returns. That's the key to consistency. Having some relative amount of risk that you're willing to put up for the amount of returns that you're going after. And you do that by keeping your risk to reward consistent. But something else has to give, as I said, and that's the width. And that's where the VIX chart that I first showed you comes in. I need to switch to that chart and then bring it over here and go back there. Trading view. All right. So you notice that on my classic out of the money fly with guide range, based on volatility, would determine how wide my fly is, keeping the same relative amount of risk that I'm putting on, or the same risk to reward, the R to R, right? So in low volatility, in the beginning, I used to go much narrower. And that's another thing I'll show you why wider is better. But in the beginning, I used to go 10 to 20, for low volatility, but I've switched that to 20 to 10. In fact, I switched it all the way up the scale here. But this is why we put on wider and wider flies, because of that sensitivity to price, and the whole risk to reward equation changes dramatically as you go into higher volatility. You can put on wider flies. You can go for the big kahuna when volatility is high. This is an anti-fragile way of trading, by the way. Yeah, there's another term that I need to bring to your attention. Anti-fragility. What is anti-fragility? That is the ability of a system to get stronger in the face of stress. So think about that. Higher volatility for most people means more stress, and it does. It is a more stressful, more active, violent situation. Wouldn't it be great that instead of running away from that stress like you do now, maybe I'll put that down in the comments. But wouldn't it be great that instead of running away from volatility because you're afraid of the profit potential that there is there and not understanding how to take advantage of it, that you instead open yourself up and ran into the fire because it made you stronger? That's what an anti-fragile system is. An anti-fragile system is one where you get stronger with the more stress that you take on. And that's exactly, again, another great reason why we trade out of the money asymmetric positions, because in higher volatility, and it's the reason why all pro traders trade that way too. Again, we're looking to make you consistently profitable, independent, and trade like a pro. A pro trades this way. A pro is looking for an anti-fragile position, a position where they can take the minimum amount of risk for the maximum amount of profit. It only makes sense. Why you're trading the other way is beyond me. It is what the crowd's doing, so you have to follow the crowd, right? Small risk, large potential reward gives you anti-fragile characteristics in your strategy. This is an anti-fragile strategy. You get stronger with the more volatility there is. In order to compensate for that, that's why we changed the width. And I'll show you another reason why you change the width and why you would want to stick with a higher width if possible. All right. Hopefully everybody is getting this. Let's see. Gary is the big commenter here. He gets the big prize. The 10% rule is crucial to this strategy. Thanks, Gary. Lots of great comments. Hey, look, if anybody else has comments, please put it up there. And if you like the way this presentation is going, give it a thumbs up. We want to see those thumbs up. Makes a big difference. I want to see your attentiveness and what you're taking in here and what it means. I'm giving you the keys to the kingdom on how you can become an effective 0 DTE options trader. All right. So, anti-fragility. That's another good reason why we trade this way. Anti-fragility. We get stronger as volatility gets higher. And not only that, we have more profit potential, less sensitivity to price, and less risk. There's 4 good reasons to do it. You get stronger. Everything about it is like a dream, yet you're not trading this way. So we have some vernacular. In the words of my 13-year-old, I got your chat. Cool. Let's see. Some older people might say, you picking up the sticks I'm laying down? All right. Getting my drift? That's from the 60s. All right. So now I'm going to talk about width and how that manifests itself. So we're going to go to this presentation here. No, not that one. We'll go to this guy right here. All right. So this is a study that I did with a similar amount of volatility that we have right now, right around 24, 25. And I wanted to see what the effect of the width of my flies were with the different widths of my fly during this level of volatility at various times during the day. So I wanted to check how premium gets affected by the width of the fly. Or I should say the rate of value increase, or that rate of decay, and the amount of premium that I have as I go to wider and wider flies. So what this is showing is I kept the risk to reward steady at 1 to 7. And all I did was I changed the width of my fly, and I measured at the center strike how much value increase there has been in that fly. And I went from 10 all the way up to 35 wide in increments of 5 or 1 strike at a time, right? And then I measured it every half hour throughout the day from the open all the way until about 3 o'clock. Now, the reason why I kept the risk to reward the same was so that I would have some level of comparison. So I know that I'm going to be spending relative to the fly and relative to the risk reward the same amount every time for the opportunity. So when I get into a 10 wide, it costs me $1.15, and a 15 wide $1.60, and then all the way up to a 35 wide, it costs me $4.50. Right? This is not taking into consideration the 10% debit rule, by the way, but it's just a basis for comparison. Now, in a 10 wide fly, you could measure that center strike, and you wouldn't see any profit at all in it until you started to get to about 12:30 in the afternoon. No growth at all. And then by 3 o'clock, the growth would, relative to the amount that you paid, would only be 70%, a 70% increase in the, and on a 15 wide fly, it was a little bit better. You started to make profit around 10:30. And also the return at 3 o'clock was much better at 213%. And I track that rate of growth down here in this chart down here. And you can see that the rate of growth starts increasing dramatically as you go wider and wider. And then this chart on the right is showing you that in a different way, you're actually seeing the rate of growth in all the different time segments until the end of the day. And you can see very clearly that as you go wider, that rate of growth starts increasing more and more rapidly. And so what it's saying there is that you're getting a much better value for the amount of money that you're paying as you go wider and wider, right? You make it sooner, and you make more, and you make it faster. That's the simple fact of the matter. Wider is better in almost every case. In all cases, wider is better. And if you can afford to go wider, then do it. Now, of course, there are limits to all of that, and your account may have limits, and we'll talk about that. We'll talk about position sizing tomorrow and the next day. So you have to compromise. Also, there's expected move, or the amount of movement that you can expect. And if you go wider, you are going to be pushed further out, but that doesn't necessarily mean that you're going to be suffering from that. That's another myth that I'll break tomorrow. But it does make sense overall to adjust your width. Now, you'll notice on my adjustments, they're not stark, but they are adjustments. So we'll go back to TradingView, and you'll see that from low volatility, where I am doing 20 to 30 wide, to the highest level of volatility, 50 plus wide. It's not a huge adjustment, but it is an adjustment. And this all came from taking thousands and thousands of trades And that adjustment makes a material difference in keeping my consistency there. And so I'll show you what that means by what I mean by consistency when I show you my trading accounts, and you'll see how this manifests itself. So we have another comment. I trade anti-fragile settings since nearly 6 months. It changed my profitability significantly. Yeah, that's exactly right. When you start trading this way, trading very small risk, large potential reward, lower win rate, your profitability becomes more consistent. And I'll repeat it again. We're after helping you become more consistent. All right, hold on. We got to bring the big head on this. This is the mantra. Become more consistent, become independent, and trade like a pro. That's what we're after. Making you a more consistent trader, more consistent profitability, trade independent. What do we mean by independent? You're going to know why you're trading this with or that with. You're going to know specifically why. Unlike all of your other retailer trader friends who have no clue. They're just putting on the same strategy and hoping. And then taking their high probability strategy and putting on stops, which effectively makes it a low probability strategy for less risk. It's crazy. It's insane. All right? I'm showing you how to never use stops. And in fact, I'll show you how you'll never even have to manage your risk ever again. The management is built in to the defined risk. So where would you rather be? Higher potential profit and not have to manage risk, and instead flip that script and take much smaller risk and manage profit. That's what you're concentrating on. And if it goes against you, it's no big deal because it's so small that it will never affect your account. And what does that mean in your account? It means that you're going to have lower drawdowns, lower volatility of returns, and more consistent growth. And that will lead to the golden egg, and that's compounding. With the way that you're trading, high win rate strategies and high volatility of returns and high drawdown, if you achieve compounding, it'll be a miracle. The fact is that 98% of you over a 5-year period are going to lose big, really big, probably bust your account. 98% of you. Our way of trading, once you get beyond a certain account size, the risk of ruin is virtually zero. And when I say that certain size, it's not a big amount. I'm talking about maybe $5,000 or so. Your risk of ruin gets down to about zero. All right? After that, it's consistent profits. And I'll talk about this later in what stair-stepping your profits mean and how you develop that consistency through discipline, through routine. Again, I talked about that last week. Develop that routine, develop the discipline, put on the right strategy, play an asymmetric position, low risk, high potential reward, lean into volatility, and you're going to start making money consistently. You'll become an independent trader, and you'll start trading like a pro. All right, there you go. Yes, and sometimes it blows through the loss stops, the stop losses, absolutely. And that's the thing most people don't take into consideration. And then they have that huge loss on their hands, and that's what causes the big drawdowns. My drawdowns never exceed 5%. Imagine if you can trade like that. Never have a drawdown below 5% of your account, ever. Let's see, there's a question. In the table you just showed us, are the numbers in the columns USD or percentages in the table? They were dollar amounts, USD. Yeah, in that table, it was showing you the value of the fly at the center strike. I was measuring the actual value. All right. Oh, looks like we got a slight increase in VIX today, but not much. Where's the ES today? We're all over the place here. So in tomorrow's episode, we're going to go over we're going to talk about the stair-step way to trading excellence. How you're going to eliminate your drawdowns and then just take what we call the roundabout, where you're playing for a tie most of the time, and then going after those big wins, those intermediate wins, but never drawing down. So make sure you tune in tomorrow, same time, 9:15, and we'll go over that, and I'll show you a real-life account that actually trades this way and how it works. And again, if you want to join our service, go down below, click the 4-week trial. You can leave anytime you want. It's billed at a week at a time. It's a very small fee. 4 weeks. Try it out. Super low risk. Find out what you've been missing and how to become consistently profitable, independent, and trade at a pro level. That's going to be your mantra from now on. All right. All right, everybody. Thank you very much. Flyonthewall.ai. Take care. Have a great day. We'll see you tomorrow.